Well, good morning, John. It's our first episode of The View of 2025. Before we really get into the meat of it, any reflections on the past year, 2024? I mean, the US markets enjoyed a second year of 20% plus returns. The Australian market, perhaps half of that. Um, any reflections on the year just past?
Well, it's important to understand if you're a US investor investing in Australia, you've made no return with the surging American dollar offsetting the Australian share market gain. And I think that's fairly sobering. So whilst we can say, look, 10% return in Australia, from an international investor's perspective, Australia's given no return. And that's reflective of our economic performance somewhat, where we've had growth, but solely driven by population and productivity declines and net income declines. And whilst we expect a recovery from that in 2025, I think it's damning of the management of the economy that sort of result occurs.
Well, we'll probably get into a discussion about the run-up to the election in due course. But what we've seen since the beginning of this calendar year is a global sell-off in bonds, which I think is one of the primary risks that the market faces. Can you give us a bit of background on why you think that's occurring and where it might go from here?
Well, I think it's occurring because the central banks of the world have released the brake somewhat, the QE brake. I suspect they'll have to bring it back shortly with bond yield management. Clearly, most of the major economies of the world, their governments can't afford to pay 4 and 5% interest on their debt when you've got a debt load of 100% GDP. So the reality is that the central banks are lax. They want to be lax and let the bond markets find its own feet, but they'll soon realise that the bond market is oversupplied and the demand can't match it. Now, obviously, the inflation cycle is what everyone's watching. If inflation can come back around the world to 2%, then bonds might stabilise at 4%. And maybe that's something that the central banks and the governments can work inside. But if inflation is 3% around the world and bonds are 5%, then you've got an issue in terms of funding. It's that intricate, Paul. So what I think is the decline in the bond market, which is interesting because I was reading some research on it. The American bond market has returned a fairly negligible return again. So two of the last 3 years has been virtually no return from the bond market. And you go back 4 years, we had a negative bond market. So the bond market as an asset class, the government bond market is not returning enough to justify it. And I've said that in the past, that it's not a viable asset class at this point in time. If it goes to 5%, then maybe it comes into the asset allocation model, but sub 4%, it doesn't suit investors.
So do you think that the bond yield rising perhaps above 5% is the primary threat to equity valuations? Just to put it in context, a couple of months ago, the 10-year bond yield in both Australia and the United States was below 4%, hovering around 3.6, 3.7. Today, knocking on the door of 4.8. That's pretty sudden upward lurch in bond yields. Is this the primary threat to markets at the moment, or do you think bond yields have just reverted to what is a more normal level post the whole GFC and COVID period?
It's a very difficult answer, a very difficult question to answer. But look, the bond market is going back to a positive yield curve. So that's if the bond market is indicative, that's good. That suggests the risk of recession is not there. It also suggests that inflation is not totally under control, and that I accept that. That's realistic. But a bond yield going up, the risk-free rate of return going up, particularly in that 5 to 10 year and even longer in some bond markets, does check the equity market. The equity market, history tells us, will respond to bond or should respond to bond yields going up, the risk-free rate of return going up. But the time it takes for the equity market to turn from exuberance to reality can be delayed. Now, the thing that will delay it is obviously issues regarding the American economy, the Trump factor, and whether American corporates, particularly at the top end, can maintain growth of double digit. So the broader American stock market has been growing earnings 7 or 8%, reasonable. The top end has been double digit plus in some parts of the IT sector. Strong growth will offset PE compression. So that's what we're looking at in America, probably PE compression due to the bond yield. Can it be offset by earnings growth? Time will tell. We're getting some numbers this week, the first December quarter numbers, but it's really about the future, not the past. Australia, on the other hand, when our bond yield goes up, we don't have the dynamic earnings growth. And those parts of the stock market in 2025, which were really dragged up by the American stock market, let's be realistic, the Australian stock market revalued based on a revaluation of the American stock market on a relative basis. So we had a revaluation of one sector, particularly the bank sector, the financial sector, which went to high teens and low 20 PEs, unprecedented, particularly when you look at the Premier Bank, Commonwealth Bank. So there are plenty of charts to show that earnings of the banks have not increased over the last 8 years. This is the total profitability of the banks. Their balance sheets have increased in terms of capital, and their return on equity has declined. Absolutely no justification for those bank shares to revalue like they did last year, particularly Commonwealth Bank. So the Australian market, aside from the American market, has a problem. We've got a very overvalued banking sector, which is 35% of the stock market. If the stock market in Australia is going to perform this year, it's unlikely to be earnings from the banking sector offsetting PE compression. So it's got to be the other sectors. It's got to be the resource sector. And the good news for the resources sector is a very weak Australian dollar, which is now coming into broker research. It's being a bit belated, but the Australian dollar has declined by 10% in the last 6 months. The iron ore price, for one, is still hovering around $100 US. You don't have to be a rocket scientist to see that that's probably lifted earnings of BHP, Rio, Fortescue by 10%. That'll come through in broker upgrades. They were downgrading, they'll probably upgrade. And so probably the next 6 months is a rotation for the Australian share market. I know this is a big, long-winded answer, Paul, but I'm sorry. Banks drifting into resources, which is pretty much where we're going to position portfolios. What can upset that? Well, obviously, yield curve maintenance, Paul. If the Trump administration directs the Federal Reserve of America covertly or directly, openly, to bring in yield management, well, then what I just talked about will not occur, and we'll still get momentum in the financial sector. So it's a very difficult outlook because we've got a new administration in America with new policies, an outspoken president. Let's just see what he does, and let's see if he actually understands what he's doing.
Yeah, well, there's no question that Trump is totally dominating the news cycle and the narrative in investment markets. He gets inaugurated on Tuesday. One effect of Trump's election has been a very, very strong US dollar. And obviously the fall in the Australian dollar. Is that going to tie the RBA's hands in its ability to lower interest rates when it meets next on, I think it's the 18th of February, or can we still expect a rate cut from the RBA?
Well, we're going to talk about common sense, and common sense says when the currency is so weak, and the inflation effects of that. Like, you just think about what a weak currency does for petrol prices. So arguably at the bowser, Australian consumers with this 10% decline in Australian dollars are paying 10% more for petrol than they should have. And petrol as an input into the cost of living and the cost of doing business, it's a substantial uplift to the cost of living. So therefore, if interest rate differentials between Australia and America, for one, mean anything, and my view on the currency, I think there's something which is driving the currency down. It's called superannuation and offshore investing, but won't have time to go through that again today. But if the Reserve Bank can do anything to defend the currency, it is maintain interest rates and let the American central bank cut theirs and try and open up, turn from a negative relative cash rate Australia to America to a positive Australian to America cash rate and try and draw international capital into Australia chasing low risk yield. And that would help the currency reset at a higher rate. So I think, to answer your question bluntly, common sense tells you there shouldn't be an interest rate cut in February because of the currency. Let's see what they do. It'll be very interesting how they get out of this one, because I think the market wants an interest rate cut. The Australian household sector is burdened by high debt, high mortgage costs, high interest rates are affecting the cost of doing business. Central banks caused this problem over many years by mismanaging the monetary policy of Australia. Now, let's see how they get out of it.
Yeah, I note that the futures markets are still predicting about a 70% probability that there will be a rate cut. And we've had recent surveys of consumers. Australia is still going through a very sluggish period, despite reasonable retail sales. There's not much consumer confidence in Australia at the moment.
Look, Paul, Australia's growing, and I pinpoint, and I'll write about this in some articles, the budget situation of Australia, which was disclosed by the Finance Department of Australia on Christmas Eve of all times. It's quite bizarre. But the budget situation for the Commonwealth in the 5 months to November is 14 billion better than projected. And the reason it's 14 billion better projected is pay-as-you-go tax collections. And the reason they're 9 billion better than expected is because there was underestimation of the employment levels of Australia and the unemployment rate. Australia's employment has swelled. There are more people employed than ever before. We've immigrated more people than ever before. And they're earning money and paying tax. So what we've got, and they're also consuming. So what you've got is economic growth, but totally driven by immigration and therefore employment. But the total growth is not faster than the immigration growth, and the growth of income is not faster than inflation. It's just matching inflation. So what you say in terms of the retail sector and consumer behaviour, yes, so there is sales growth in the economy, across the economy. There's income growth, but per capita it's going down.
Yeah. So, like we've spoken about on quite a few occasions, we're in a per capita recession in Australia. But in the meantime, the government's collected a nice little pot of money to be used in the run-up.
They have, and
the
Paul,
election in May.
And I'll make this point. The diatribe coming out of economists, I know you quoted recently the 7%, this view that there's going to be interest rate cuts, and the consensus, I think we've got to ignore the consensus and look at reality. Australia's taxation system is diabolical. The fact that $9 billion of income tax is being collected higher than forecast in 5 months after a general tax cut, which started July 1, which was delayed, and why the government hasn't sat down with the unions, particularly the public service unions, and say, look, we will give you a higher tax cut, but you have to restrain wages claims because we're giving it to you in tax cuts. What has happened is we've had a poorly structured tax cut July 1, no thought about it, no negotiation with the public sector unions, which are causing the issue in the budget. And not only in the Commonwealth budget, but all state government budgets, we've got this around Australia claim by state public servants for catch-up wages because they're on a different negotiation or different thought process to the Commonwealth. And it's going to affect budgets going forward. We've seen the disclosure prior to Christmas that the Department of Finance and the Treasury forgot to budget for wage increases for the Commonwealth public servants going up the next 3 years. This is idiotic, what's going on in this country. And it is depressing. If you're a foreigner looking at Australia, looking at the governance of the country, looking at the leadership, looking at the plans, there's nothing. I sat, for 2 weeks in Asia, having a holiday before Christmas, and you just look at the diatribe coming out of Australia, the nonsense. There's nothing, totally nothing going on in this country in terms of a vision or a plan. It's quite disconcerting.
Yeah. We'll have to end it shortly, but I thought it's worthwhile just remembering what an impact COVID had on our lives. We're just at the 5-year anniversary of the first COVID deaths being reported out of Wuhan in China 5 years ago. It really disrupted all of our lives. It's incredible that it's what a period in our lives. But the impact on investment markets, a lot of the companies that benefited initially from COVID and lockdowns, companies like Moderna, which produce the vaccines, companies like Zoom, which we're utilizing right now, they rose and then have subsequently fallen back. Tourism's recovered, recreation and leisure activities have recovered. The one sector which really benefited was big technology, as we learned to work from home, and virtually every small business, large business, medium-sized business used the opportunity to upgrade their IT systems, to keep in touch with their customers, employees, and so on. The one sector which hasn't recovered from lockdown is office property. That's a big sector. John, do you think that that's a permanent realignment of property values, or it's just one more thing which is just taking a bit longer to recover?
It'll recover. And I think the devaluation of the Australian dollar, I think Australian commercial property, on a contrarian view, will come very starkly back into play by foreign investors, foreign pension funds. And the Australian pension industry better watch out that it doesn't sell short Australian commercial property. We are still a high growth economy driven by immigration, and immigration feeds employment, employment feeds office space. So if you take a 5-year view, there will be strong tailwinds for the office sector, and then get back to the office edicts. And we've all seen the mental health issues of working from home, and that we're dodging it, and people are denying it. It's not good for humans to work in isolated areas. God forbid. I think we should learn that, and we need to have stronger management of the economy and stronger management of the issues caused by working from home edicts or demands. So I'm saying that we've got to be very careful. The Australian dollar is putting Australia assets in play. There's a clear indication or example of this with Star City casinos, of all things. We've got a foreign investor lurking up the register there, who probably sees, yes, I wouldn't suggest anyone watching this program, watching this video, goes charging in there, but I can see an international investor grabbing a major Australian asset, which includes property. There are issues in terms of gambling, but putting that aside, it's a big property play at a devalued asset in very strategic assets when you look at them. And foreigners see that, whereas Australians sitting inside the bubble run for cover, foreigners will see the value. And I just think Star City is an interesting example of what will happen. I think the property sector of Australia, and even the listed property sector of Australia, there will be acquisition, there will be foreign takeover bids, there will be private equity bids coming if that Australian dollar goes much further lower.
Very, very interesting. So there's a good contrarian suggestion there. John, thank you so much. A very interesting discussion. We'll see you next week.
Thanks.